Will October mark the next Bitcoin shopping spree? It took 6 months for bulls to recover and take the market back, but now that we're finally here, new on-chain data suggests a supply shock is behind it all. And this one has the potential to shock not just supply, but investors themselves. Welcome to the Shrimpy YouTube channel, where we help guide our investors through the world of crypto. In today's video, we'll take a look at a concept that has had our community hypnotized for years. No, it's not those ETFs everyone's talking about. We're going to discuss a rare event that turns assets upside down and brings on severe price swings: supply shocks. The laws of supply and demand dominate cryptocurrencies. Bitcoin has a fixed supply, so when Bitcoins become scarce, the price tends to go up. But when we look at the market and the effect supply has on prices, we don't think about all 21 million Bitcoins. We focus on the amount available to buy on exchanges. And when whales decide to move their coins off of exchanges and into cold storage, they take them out of circulation and therefore out of exchanges. Those who own millions in crypto can't risk storing their assets on centralized exchanges. Surprise regulations and hacks can eradicate crypto wealth overnight. To ensure the security of their funds, whales store most of their coins on hardware wallets. The only time those assets make it to the exchange is when the investor wants to sell. Therefore, a significant portion of Bitcoin has remained locked out of the market. When this happens, investors create scarcity. They accumulate coins and have no interest in selling. This leads the market to believe that investors are bullish on Bitcoin's price. And thanks to Bitcoin's transparency, we can study blockchain networks to discover Bitcoin's supply on exchanges at any given time. As of August 2021, on-chain analytics showed Bitcoin flying out of exchanges at up to 100,000 Bitcoin per month. This isn't anything new, as coins have consistently fled exchanges for the better part of the last 2 years, and they've shown no signs of returning. But what's the cause behind these dramatic outflows? We have two main theories that might explain what's going on, and in this video, we'll explain both to provide you with a better understanding of crypto's market dynamics. But before we look at that, let's turn it over to Jade to learn more about supply shocks and how they influence the markets.
Hi guys, Jade here. Supply shocks are complex economic phenomenons that involve plenty of $5 terms such as price equilibrium, aggregate supply and demand curve, production output, and plenty more where those came from. Thankfully, we'll spare you the 1-hour lecture and the pop quiz. Instead, we'll explain supply shocks so that literally everyone can understand them. Well, okay, maybe not a 5-year-old. A supply shock is a rare event that occurs when some external cause disturbs the supply of a product or commodity. Despite the name, supply shocks can be either negative or positive. If an innovation increases production rates for a product, or if we discover a large deposit of a rare material, then the supply shock is positive for consumers and prices decrease. On the other hand, a negative supply shock occurs when supplies suddenly drop. For example, extreme weather can ruin crops and plummet the supply of corn. Alternatively, a country rich with raw materials can face unstable geopolitical conditions or terrorist attacks, making their extraction difficult. I think that might be where we lost the 5-year-olds. In both cases, supply moves up or down while demand stays the same. Negative supply shocks are far more common, and when they occur, the price of a product increases sharply. We've seen a lot of negative supply shocks in the past few years. In 2020, a global microchip shortage led to tech products such as graphics cards selling for up to 5 times their original price. The demand for electronics stayed the same, but their supply was so low that retailers had to spike the price. More recently, remember the Evergreen container ship that blocked the Suez Canal for an entire week? That ship collapsed the global supply chain. Boats were forced to reroute, which caused products to reach their destinations a month past their due date. In the cryptocurrency market, we can see supply shocks coming by following the on-chain data. Exchange outflows are a great indicator of how much of Bitcoin's supply is located on crypto exchanges where we can trade them. Some believe that investors make use of this data to predict whether the market is bullish or bearish. In the following section of the video, we will take a look at the data to see how exchange supplies interact with market sentiments and lead to a shift in prices. Now that you're a supply shock genius, Let's look at the two dominant theories that explain why Bitcoin is moving off the exchanges in such a dramatic fashion, beginning with the first and most popular theory.
In 2020, on-chain analytics saw a new trend. Although the number of investors increased, the amount of crypto stored on exchanges did not. In fact, it decreased. Once we noticed the trend, it began to influence prices and the community's optimism. What's odd is that outflows continued to rise at that time without any obvious reason. Someone was hoarding Bitcoin, but who? One popular theory is that institutional investors were behind it all. They may have realized that the Bitcoin market matured and that cryptocurrencies were here to stay. Finally caving in, they joined us and secured their position in the world's fastest growing financial market. At first, this theory had no proof. But as invisible forces drained exchange reserves, it became apparent that something big was happening. As time went on, we got a confirmation. Michael Saylor, the CEO behind software company MicroStrategy, announced in August that he had allocated $250 million of the firm's capital to buy Bitcoin, making MicroStrategy the first private company to invest in digital assets. This kicked off a dramatic series of investments. Over the next few months, Saylor announced more investments, and by December 2020, MicroStrategy held $1 billion in Bitcoin. Saylor's venture lit a fuse, and soon enough, more investors started throwing money at Bitcoin. Grayscale's Bitcoin Trust Fund saw weekly inflows of up to $200 million and went from owning $2.3 billion in coins in January to $6.5 billion in October. By December, the fund held nearly $8.3 billion in Bitcoin. And by the end of the year, 10 public companies invested in crypto, including big names like Morgan Stanley, Tesla, and Square. Private capital was flowing into crypto, and as each company hopped on the coin train, the retail market exploded with frenzy. 2020 was widely regarded as the year Bitcoin went institutional, and we observe those effects today. Aside from institutional interest, two other factors took part in draining exchange reserves: regulatory fear and exchange distrust. In the first case, the controversy surrounding Facebook's Libra stablecoin convinced governments all over the world that cryptocurrencies had the potential to impact global monetary stability. This led to a phase of new regulatory discussions that shook the trading community. Rumors of bans and exchange shutdowns sparked fear and pushed whales to move coins back to cold storage. In the second case, the arrest of BitMEX CEO Arthur Hayes over fraud and money laundering allegations had an enormous impact on trust. Investors no longer felt safe using trading platforms for custody purposes. Combined with institutional accumulation and regulatory fears, large exchange outflows might not be that strange after all. Before we continue, make sure to hit that red subscribe button and join our online community. But we have another theory that might explain why Bitcoin is in for a supply shock. Staking and DeFi protocols are driving these massive outflows. Even though we have plenty of reasons to believe that institutional investors and old-school Bitcoin whales are the cause of growing exchange outflows, some in the community disagree. Our second theory proposes that Bitcoin, Ethereum, and all other cryptocurrencies were not snaking their way into private wallets, but rather into decentralized applications. This trend perfectly coincides with another novelty in crypto: decentralized finance. Decentralized finance is a market segment that focuses on turning traditional investment instruments into decentralized ones by using the power of blockchain technology. Most of these converted financial instruments are found on decentralized applications, or dApps, that exist on the Ethereum network. DeFi offers amazing returns for those willing to lock up collateral. Services like yield farming and lending offer up to 800% yields that overshadow what we see in the traditional banking system. Anyone interested in making money fast gravitates towards such groundbreaking sectors. From that perspective, it's not strange to consider that crypto, once stored on exchange wallet, has gone toward DeFi's decentralized applications. But that leaves one question unanswered. How did whales join DeFi on Ethereum using Bitcoin? The obvious option is to sell your Bitcoin in exchange for Ether. But if you're a hardcore maximalist who wants to retain ownership over Bitcoin while reaping the benefits of DeFi at the same time, selling is not an option. To avoid selling your Bitcoin, you wrap it. Wrapping tokens is a process where a coin, like Bitcoin, becomes an ERC20 token that you can use on the Ethereum network. This token may then be exchanged for other ERC tokens that are compatible with DeFi's yield products. The original coins are sent off to the platform that facilitates this wrapping process, and the user is free to deposit his new asset onto Ethereum's smart contracts. Taking a look at the data, it's clear that a huge amount of money flew into DeFi in 2020. Within the span of a year, that niche market grew from $8 billion to $25 billion. Again, we note that the entirety of this capital left exchanges to be locked up in liquidity pools on smart contracts. Users staked, borrowed, and farmed assets in a new gold rush that made it possible to invest in crypto and make money passively by contributing cryptocurrency liquidity to these DeFi applications. Decentralized exchanges, another major DeFi service, also took part in draining funds from traditional exchanges. Since the new decentralized exchange model offers vastly more tokens than its counterpart, investors flocked to platforms like Uniswap and SushiSwap. It's also worth pointing out that decentralized exchanges enforce no KYC measures, which attracted many investors who wish to remain anonymous. And decentralized exchanges are non-custodial. They don't hold on to your crypto. What this meant is that you could keep your tokens in your own wallet and still trade them on a decentralized exchange. You can store assets on a private wallet like MetaMask and swap tokens by making a temporary connection with the decentralized exchange. All these factors pushed funds away from centralized exchanges. According to some, and in our opinion, the mysterious exchange outflows that we see are not happening due to institutional accumulation, but as a consequence of DeFi's massive popularity. No matter which theory is right, one thing remains the same. Bitcoin supply on cryptocurrency exchanges is falling and fast. Prices will continue to increase, and buyers will have an easier time breaching important resistance levels due to exchange liquidity. But then again, nothing is set in stone. Whales can easily swap exchanges with coins and cause a collapse in the crypto market. So if your investing thesis is based on supply shocks alone, make sure to keep an eye out for any sudden exchange inflows. Although our first theory is more popular, a small portion of analysts believe that the community has it all wrong. And can we blame them for thinking that? After all, Bitcoin had a rough time in 2019 after topping out and failing to break $14,000. The narrative changed when smart contract developers introduced DeFi and created dozens of platforms that enabled investors to make more money with existing crypto assets. No doubt that those platforms and FUD have urged Bitcoin out of centralized exchanges and into the warm, anonymous embrace of decentralized finance. As always, thank you for tuning into the Shrimpy YouTube channel. We love providing our investors with crypto news and the latest updates from the Shrimpy team. If you have feedback for us or want to learn more about the Shrimpy platform, leave a comment or visit our website and find the link in the description box below. And don't forget to hit that red subscribe button to join our online crypto community. Happy trading!